Your credit score decides if you get a loan, a house, or even a job. Banks want you to believe it's just a simple number, but the truth is shocking. This score doesn't just show financial responsibility, it reflects hidden systems of control. What if I told you banks don't want you to know how it really works? Because the less you know, the more money they make from your mistakes. And if you're serious about money freedom, this is where it begins. So grab your notepad, because the truth might shock you. Here are the secrets banks don't want you to know about your credit score. Let's get started. 1. Why credit scores exist in the first place. Most people think credit scores exist to reward good financial behavior, but the reality is much darker. The modern credit score system was built not to protect you, but to protect lenders. Banks use it as a safety net to decide how much risk you are to them, not how responsible you are as a person. Your score doesn't care about your savings account or how much cash you actually have. Instead, it focuses on how much money you owe and how reliably you make payments on borrowed money. This means the system rewards debt rather than true financial independence. If you avoid debt completely, you can still have a low credit score. It sounds backwards, but it's intentional, because the credit score was designed by banks and credit bureaus to make sure you keep borrowing. 2. The biggest factor banks hide. You may already know that payment history matters, but banks downplay the second biggest factor: utilization. Credit utilization is the percentage of credit you use compared to the total available limit. Here's the catch. Banks profit most when you keep this percentage high. Carrying large balances means more interest payments for them. But in reality, keeping your utilization under 30%, or better yet under 10%, boosts your score the fastest. The trap is, banks don't explain how dangerous it is to max out your cards, even if you pay them off later. They quietly use this to keep your score suppressed, so they can justify charging you higher interest rates on loans. 3. Why paying on time isn't enough. We're told constantly that paying bills on time is all it takes to build good credit. But here's the truth. On-time payments alone won't get you a great score. While payment history makes up the largest percentage, it's just one part of the puzzle. You could pay on time for years, but if your utilization is high, your score still suffers. Or if you only have one account, your credit mix works against you. Banks like to promote the just pay on time myth because it keeps you unaware of the deeper strategies. In reality, raising your score takes a balance of factors. Length of history, types of accounts, utilization, and inquiries all matter. So yes, paying on time prevents damage, but it doesn't maximize growth. 4. The hidden power of credit mix. One of the least talked about factors is credit mix, yet it can account for around 10% of your score. Credit mix refers to the variety of accounts you manage, such as credit cards, auto loans, mortgages, or personal loans. The system favors people who juggle different types of credit successfully. Why? Because banks profit most from people with multiple accounts. They call it healthy credit use, but really it's training you to be comfortable with multiple debts at once. If you only use one credit card and avoid other debt, your score can plateau. This forces many people into taking on extra accounts just to raise their score. It's a trick because managing more debt means more interest, more fees, and more dependence on banks. 5. How hard inquiries quietly hurt you. Every time you apply for credit, lenders run a hard inquiry on your report. What most banks don't tell you is that these inquiries can quietly drag your score down. Even if you're approved, you're punished for simply trying. It's as if the system wants to discourage you from seeking better deals. For example, shopping around for a mortgage or car loan can add multiple inquiries in a short time, lowering your score temporarily. Banks benefit from this because it locks you into the first deal you accept, often with higher interest. They count on you not wanting to risk damaging your score further. The trick is to group inquiries for the same type of loan within a short window, usually 14 to 45 days, so they count as one. But you'll rarely hear this advice from banks because the confusion works in their favor. 6. Why closing old accounts can backfire. It feels smart to close old credit cards you no longer use, but doing so can tank your score. This is because your credit age, how long your accounts have been open, matters more than you think. The longer your average account history, the better your score. Closing old accounts shortens this history instantly. Even if the card sits unused, its age benefits your profile. Banks know most people close accounts to simplify finances, but this act usually lowers their score and makes them easier targets for higher interest rates later. That's why one of the smartest moves is to keep old accounts open with occasional small purchases. 7. The secret behind minimum payments. Here's a truth banks love hiding. Making minimum payments keeps you trapped in debt for decades. Minimum payments are calculated to benefit banks, not you. If you only pay the minimum, the interest adds up so heavily that you could end up paying back double or even triple what you borrowed. And while making minimum payments keeps your account current for your credit report, it doesn't actually reduce your debt meaningfully. This creates a false sense of progress, where your score looks fine, but your finances are stuck. Banks rely on this because minimum payments generate billions in interest every year. To break free, pay more than the minimum, even if it's just a little extra each month. 8. Why debt-to-income ratio matters too. Most people focus only on their credit score, but lenders secretly pay close attention to something else: your debt-to-income ratio. This measures how much of your income goes toward debt payments every month. Even with a good credit score, a high ratio can get you denied for loans or force you into worse terms. Banks don't advertise this because it reveals how much control your income has over your borrowing power. They'd rather you focus only on the score, not the bigger picture. Smart borrowers know to keep their debt-to-income ratio under 36% for the best approvals. This means managing not just your score, but how much of your income is already locked into debts. 9. The myth of credit repair shortcuts. The credit repair industry thrives on selling quick fixes, but most of them are myths. Banks and bureaus want you to believe your score can't change quickly, so you'll stay trapped longer. The truth is, legitimate improvements can happen in months, not years, if you know what to focus on. Simple actions like lowering utilization, disputing errors, or becoming an authorized user on a seasoned account can raise scores fast. But because these tricks cut into bank profits, they're rarely shared openly. Instead, shady repair companies charge you for what you could do yourself for free. The real shortcut isn't paying someone else. It's learning the system and applying pressure where it counts. 10. The real reason banks want you confused. At the end of the day, confusion is the bank's greatest weapon. The average person doesn't know how credit scores are calculated, which factors matter most, or how to optimize them. And that ignorance costs thousands in extra interest, fees, and lost opportunities every year. Banks profit when you stay confused, so they flood you with partial truths and vague advice. They tell you enough to keep you playing the game, but never enough to help you win it. The reality is, your credit score is less about responsibility and more about control. Once you understand the rules, you realize it's a game you can actually win, but only if you step outside the system of half-truths they've built. Now you know the truth about credit scores and why banks don't want you to. This knowledge can save you thousands of dollars over your lifetime. So the question is, what will you do with it? If you found this video eye-opening, make sure to hit like right now. Subscribe for more deep financial truths they don't want you to hear, and share this video with someone stuck in the system. They need it too.